Good day, guys. Welcome back to another session with the Financial Coconut. But today we're going to talk about something a bit more complicated called reading financial statements, right? We want to choose a good company and want to be able to understand some basics of financial statements, short for FS. But if you believe that you can learn everything you need to know about FS, financial statements, in 15 to 20 minutes in a podcast, then you think too much, right? But I'm going to share with you some points to get you started, because these are some things that I look at when deciding whether or not I should further develop and further analyze this company. Today we're going to talk about 3 points in the financial statements to choose a good company. So good morning, everyone. I welcome you to another day with the Financial Coconut. In our podcast, we'll be debunking financial myths, discovering best financial practices, discussing financial strategies that fits our unique life. You get it. Ultimately empowering us to create a life we love while managing our finances well. And today's topic is 3 things to look out for in the financial statements while choosing a good company. So there are many ways to choose companies, and everyone have their own preferences. This one, over time, you will learn. Right? Some people like dividend monsters, companies that give out a lot of dividend because they're very profitable. They constantly give out a lot of dividend. Or some people like growth companies, right? Companies that are like slightly smaller, maybe number 3, number 4 in their game, and they're growing fast and, eating the lunch of the big boys. Or some people just like buying the big boys and holding it for the long term. So over time, you will be able to create your own palette as to what kind of companies do you like, right? But today, I'm going to share with you some points to get you started. So the first question definitely is, what is a good company, right? How do we then define a good company? And when I look at it, a good company is a company with increasingly profitable, with a good return on capital and very little debt. Right? Well, many parts. I'm going to 3 parts essentially. Increasingly profitable, number 1. Number 2, good return on capital. Number 3, very little debt. These are 3 points, and we're going to be focusing on these 3 points. And how do we look out for these 3 points in the financial statement? Of course, before we dive deeper, I need to put out a caveat out there, right? Numbers is not everything. Once again, I think too many people try to make investing like a science. So you look out for this number, it's growing, and then put everything into a formula. Okay, can buy, what price to buy? Right? There are complexities within this thing, especially if you don't understand the business, right? So last episode, I talked about growing your business acumen, and to me, that's very important because numbers alone don't paint the picture. You need to know why the numbers work this way, and you need to understand the business. You need to understand how Facebook makes money, right? You need to understand how Starbucks make their money. You need to understand how Disney make their money. They all run very different business models. And if you just look at the financial statements side by side, they make no sense one. They just show you a set of numbers, right? So we need to grow our business acumen. And that is a complex job that will take over time, right? So read the yearly financial report. They should give you a better idea. And further down the road, we will discuss individual companies. That's why we're setting the precedence of how to then choose a good company looking at financial statements. And next week, we'll dive deeper to look at a qualitative analysis, looking at the management, looking at economic mode, blah, 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 all those kind of stuff. But today, we're going to talk about FS, and let me recall the 3 points. The first point is to look for an increasingly profitable company. The second point is that the company must have a good return on capital. And the number 3 point is the company must have very little debt. Right, and let me share with you how we're going to start. So the first point, right, increasingly profitable company. How do you validate a company is increasingly profitable? And the assumption here is that if a company makes more money, that means it becomes more valuable and the stock price will go up. That is the assumption, yeah? Of course, that doesn't always happen, but underlying all these noise and clutter, that is our belief as fundamental investors. That is my belief that if a company becomes more profitable over time, the stock price will go up and we will reflect the quality of that business. And yes, if you have not heard the previous episode about the 3 apps I use, you can go and check out that episode. And the first app that you should use when we're talking about financials is Guru Focus, because they aggregate all the information, right? So all the different years of financial information, all the financial statements, they put together in an Excel sheet, something like that. So it's very easy for you to compare. And I'm going to give you 5 points to look out for an increasingly profitable company. Yes, bear with me. This is a complicated episode. There are a lot of points and sub-points. So 5 factors to look at, 5 points to look at to indicate that there's an increasingly profitable company in front of you. Number 1 is growing revenue. Revenue definitely must grow, right? Because that is the top line. That is the amount of sales that's coming in. So if Nike is growing revenue, that means they're selling more shoes, right? If Starbucks is growing revenue, that means there are more and more Starbucks chains opening and more sales of coffee, right? If Visa is growing revenue. If you don't know Visa, I don't know where you live, like. Visa is growing revenue. That means more and more people are transacting on Visa, right? Using cards and using digital payments, right? So you want to see top line revenue growth because that indicates the business is growing. Of course, there will be times when the growth is slowing, right? So if a company is growing at 20% year on year, that means every year it grows at 20% for the past 5 years, and then suddenly it comes down to like 10 or like 5%, then you got to question what is happening in the company, right? So that doesn't mean that the company is no longer worth. You got to find out what is going on, and that is when we observe anomalies, right? When something is off the trend, we want to see, hey, why this is different from previously, right? So observe increasing revenue, and if you observe anomaly, definitely ask yourself why. Number 2, you got to observe increasing net income. So revenue is one thing, but sometimes a company is spending a lot of money to grow revenue, and it is eating into their income. Their margins are shrinking. So when I look at it, I want to see a company maintaining margins. That means if they are making 50% on every dollar, then I want to see them continue to make 50% on every dollar, and that should reflect on their net income. If their net income is growing, that's good job. If their net income is not growing, then you gotta once again question yourself why. And these things I'm going to share, these 5 points to observe for increasingly profitable company, is not hard and fast. If you see something off tangent, that means it is different from how it used to be. That means if it's always growing at 20%, suddenly it's not growing as much. Or if it's always profitable, then suddenly plane crash, then not profitable. Then you got to realize that is an anomaly and ask yourself what is going on. Okay, and the third point is you must see increasing cash flow from operations, because ultimately a business needs to make money. There are many times when the business records revenue, records net income, but cash flow is not coming in. Maybe because it is a longer term business, like for a lot of the gaming companies, they register bookings, they register revenue in front, but the money haven't come in yet. Right, so to me that is very important because I want to see money coming into the business, right? So cash flow from operations is very important for me. And number 3 point is increasing free cash flow. So free cash flow essentially is cash flow from operations minus operating expenses minus capital expenditures. So minus all the other things, net. Extra cash is essentially called extra money, right? So after they make the money from operations, they minus all the expenses that they need, and then free extra cash. There's free cash flow, okay? This is very important because free cash flow allows a company to expand, to invest, to look at other things. So we want to see companies with free cash flow. Especially if you're looking for dividend, you want a company with a lot of cash flow. Yeah? And number 3, the 5th point is increasing free cash flow per share. Why per share is important? Because sometimes they sell more shares, through this process, and you get diluted. So at first you make $2 per share, free cash flow per share. Then suddenly they decide that they're going to sell more equity, and then it becomes like $1 per share. And then you got to question why, what's going on? Why are they raising money? So yeah, following me, this is complicated for sure, but I hope that these 5 points alone can give you a decent insight into observing an increasingly profitable company, right? So increasingly profitable company, look at these 5 sub points. If they all tick the box, that means increasing revenue, increasing net income, increasing cash flow for operation, increasing free cash flow, increasing free cash flow per share, then yes, you can consider this company and further dive deeper into your analysis. Whew, finally we're done with point 1. This is a little bit complex and I hope you're following. If not, let me know and let's see what we can do, okay, to help everyone to become a better investor. Which brings me to point number 2. How do we choose a good company? Point number 2, we want good return on capital, right? So how then do we observe good return on capital within the financial statement? Right? I look at one I look at two matrix and their interaction. Okay, so number one is return on invested capital, which is usually denoted as ROIC within the FS. Okay, look at the financial statement, you see ROIC. FS is financial statement. So you see ROIC, return on invested capital, which essentially means for the amount of capital that I put in, how much do I get? Okay, so you want to see positive ROIC. If a company is spending $1 and then like losing money, right, for every dollar, then you don't know what they're doing also lah. So you definitely want to see a positive ROIC. You want to see a company making money from every dollar that they invest, right? They got good returns. So you will see that a lot of tech companies have very high ROIC. Certain companies are a lot leaner in terms of like staples, consumer staples, or like oil. A lot of oil companies struggling. Their ROIC is in negative territory. But more importantly, you want to compare ROIC with WACC. What is WACC? Weighted average cost of capital. Essentially, how much does it cost to borrow money lah? Right, so there are two kinds of capital in the market: equity and debt. Yes, equity is 要给钱, right? So equity, right, you got to give dividend. There's a dividend expectation. And debt, you got to pay interest from a company's viewpoint, right? So they either raise money through debt or they raise money through equity. Either way, they need to pay, which is why there is a cost to the capital, weighted average cost of capital, right? So you want to see that ROIC is bigger than WACC, and all this you can find within the FS, within the financial statement. Usually ROIC is above with WACC. You can see as long as ROIC is bigger than WACC, that is a good sign, because the company is growing and investing its capital well, such that it's getting returns and it is bigger than the cost of the capital that they are using. Of course, we can go into deep detail. There is formulas to all this. How do they calculate it? But if you love that, do it, okay? It's very easy to find. At least I give you a head start. But more importantly, when I look at the FS, I want to see ROIC bigger than WACC, because it shows me that the company has a good return on capital. Every dollar that they invest, they are making more money than the cost of that dollar. So that is important, choosing a good company. Brings me to my third point. The third point is to choose a company with very little debt. And the question is, how little is little, right? Best is no debt lah, right? Which is very, very rare, very tough to find companies that have no debt, they are listed. So if you find one, then it is quite a gem, take a deep dive and understand what's going on. And when I look at debt, more often than not, I'm looking at long-term debt. Okay, I'm looking at long-term debt, because in the financial statements they will have short-term debt, and there's long-term debt. So short-term debt usually are bridging loans. They are like not super, not that big of an issue in terms of operations, because usually they just kind of tie through. What is important is those long-term debt that company takes on to like invest in a new venture, do a merger, and that is extremely important, because those things eat into your finances. They eat into the cash flow that the company is making. It can range from 5% interest to like 8%, 9% interest, depending on the health of the company, right? So long-term debt definitely eats into the profitability of the company, and we want to make sure that the company has very little debt. And how do you see very little debt? You look at long-term debt, compare it with free cash flow. Why is it important? Because free cash flow is the money that you can use to pay off the debt, right? You want to see the company has money to pay off the debt, and you want to make sure that long-term debt is smaller than 5 times of free cash flow. What does it mean? It means that if a company doesn't grow massively, in 5 years at least it can pay off the debt and become debt-free. I definitely do not want to see my companies, the companies that I own, go bankrupt. And more often than not, big companies tend not to have these issues. But if you're looking at up and coming startups, smaller tech companies or biomedical companies, which I highly do not encourage if you're not seasoned. But if you want to look at all these, they have very big debt and they don't exactly make a lot of money. So you got to look at that. Okay, so which sums up my 3 points for today. I hope you follow through. If you have a lot of questions, feel free to email me and we can talk about it. So how do we choose a good company? Looking at the financial statements, the first thing is you want to observe an increasingly profitable company, which I've shared with you 5 sub-points, which is to look at increasing revenue, increasing net income, increasing free cash flow from operations, increasing free cash flow, and increasing free cash flow per share. You look at these 5 points, it should indicate whether the company is increasingly profitable. Okay. Number 2 point is good returns on capital. Right? ROIC bigger than WACC. And the third point is to find a company with very little debt, which means the long-term debt is smaller than 5x free cash flow. So all these are pointers that I look at before deciding whether I want to go further into understanding the business, seeing the future, and analyzing the management and all those kind of stuff. Right? So I hope you learned something useful today. If you have other points that you use to evaluate a company through their financial statements, do share with us. Let us grow as a community. See ya! Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the financial coconut. Knowledge is that much more powerful and interesting when shared, debated, and discussed. I hope you would share what you've gained with people you love, and I want to hear from you. Give me some questions and help me along with building a community of financially savvy coconuts. I hope together we can fulfill our curious minds and our desire for clarity. Email me at thefinancialcoconut@gmail.com. Message me on Facebook or join our community Telegram group. I will do my best to address your questions in a future podcast series, especially if many people are concerned about the same topic. With that, have a great day ahead, stay tuned next week, and always remember, personal finance can be chill, clear, and sustainable for all.